You can risk 1% per trade and still lose everything in a single afternoon. Not because you broke your rules, but because you followed them perfectly. This is the trap that destroys careful traders. The disciplined ones. The ones who journal, who set stops, who never bet the farm. And almost none of them see it coming. The reason is a piece of hidden math that quietly stacks behind every position you open. It's called correlation risk. And by the end of this video, you'll never look at your open trades the same way again. Let's start with the story you tell yourself. You've read the books. You know the golden rule, never risk more than 1 or 2% of your account on any single trade. So you're safe, right? Even if you take 5 losses in a row, you're only down 5%. That's survivable. That's professional. That's exactly what the rule is designed to protect you from. Here's where it falls apart. The 1% rule only works if your trades are independent. If each one can win or lose on its own. And most of the time, they can't. Picture this. You spot a strong setup. You go long. You feel good, so you find a second stock with a similar chart. Then a third. A fourth. A fifth. 5 positions, each risking 1%. You feel diversified. But look closer. All 5 are tech stocks. All 5 move with the same market mood. All 5 rally together on good news, and crash together on bad news. You didn't open 5 trades. You opened 1 trade 5 times. That's correlation. When 2 assets move together, they aren't separate bets. They're echoes of the same bet. And when the market turns, they don't fall one at a time, they fall all at once. Now the math gets ugly. You thought your worst case was 1%. But if all 5 are perfectly correlated and they all hit their stops in the same afternoon, that's not 1%. That's 5%, gone in one move. And 5% is the optimistic version. Because correlated assets don't just fall together. In a panic, they gap. Your stop at -1% fills at -3. Times 5 positions. Suddenly the careful trader who never risked more than 1% is staring at a 15% drawdown. From a single event. On a single afternoon. While technically following every rule in the book. This is why correlation risk is so dangerous. It hides inside good discipline. The position sizing looks perfect on each trade. The danger only appears when you add them together, and almost nobody does that math. Let me show you how sneaky it gets. Correlation isn't just about owning 5 stocks in the same sector. Say you go long a tech stock, short a safe haven currency, buy a growth ETF, and take a position in crypto. Feels like 4 different markets. 4 different asset classes. Real diversification. But under the hood, all 4 are the same bet, a bet that risk appetite stays high. That investors keep reaching for growth. The moment fear hits the market, every single one of those trades moves against you at the same time. That's the hidden truth. Correlation isn't about what an asset is called. It's about what drives it. 2 things that look completely different can secretly be powered by the same engine. And here's the cruel twist. Correlations aren't even stable. In calm markets, assets drift apart and look nicely diversified. But in a crisis, exactly when you need protection, correlations snap toward one. Everything sells off together. The diversification you counted on vanishes at the worst possible moment. Traders call it correlation going to 1. It's the reason so many blow-ups happen fast. So what does a real professional do differently? They don't measure risk trade by trade. They measure it at the portfolio level. They ask one question the amateur never asks. If my single worst nightmare scenario plays out, if the whole theme I'm betting on reverses, how much do I actually lose across everything at once? That number is your true risk. Not the 1% on any one ticket. The total damage when your correlated positions all break the same way on the same day. Once you see risk that way, the fix becomes obvious. You cap your total exposure to any single theme. If 5 positions are really one bet, you size them as one bet, splitting that 1% between them, not stacking it 5 times. You hunt for trades driven by genuinely different forces. Something that can rise while your other ideas fall. Real diversification isn't more positions. It's uncorrelated positions. And you assume that in a crisis, everything you own is secretly connected until proven otherwise. You plan for correlation to spike to 1, because when it matters most, it usually does. Here's the mindset shift that ties it all together. Stop counting your positions. Start counting your bets. 10 trades might be one bet. Or 3 genuinely independent ones. The number on your screen means nothing. The careful trader who blows up isn't reckless. They're just adding 1% to 1% to 1%, never realizing they're all the same 1%, multiplied. Discipline on a single trade means nothing if your whole book leans the same direction. Survival comes from understanding what you're really exposed to, not how many tickets you've written. So before your next batch of trades, ask the uncomfortable question, are these 5 ideas, or one idea wearing 5 costumes? The answer might be the only thing standing between you and that afternoon you never see coming.